There are about a million ways to earn money in this generation. You can either work or start a business, open a garage sale at home, or buy or purchase, etc. Yes, you heard us right. You can buy your way into earning money. As a matter of fact, buying can earn you lots of money, perhaps even faster. Most of us are probably aware of this. This is called investing, and it works most of the time, especially when done right and with a great strategy. Investing as a way to earn involves a lot of buying, but not just any random things. You're going to be buying stocks. How it works can be a little tricky, especially if you haven't tried it before. It's going to take a lot of learning. But what are stocks and how can investing in them help you gain tons of money? Hey, welcome to Stock Market Made. Today we're going to provide you with a simple explanation about how stocks can earn you money. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. In anything new, the first thing you need to know are the basics. This is to later form a deeper understanding of the subject and therefore be able to perform well in it. The same is true for when you're starting out on investing. With that being said, here are the most basic details that you need to know in order to grasp its concept. What is a stock? Let's begin by discussing a little bit about stocks. What is it? For many, stocks are the foundation of investing, as stocks allow people to have a role and participate in corporate success. Stocks, in simple terms, are shares of a company. If you buy stock, you're basically buying a portion of a company, and as a result, you become a stockholder or shareholder. Stocks are also called equities, and in the stock market, you'll often hear people use this term, so take note of that. When you become a stockholder of a company, you'll be entitled to receive a return for your investment, which is called a dividend. A company typically pays its shareholders a dividend out of its profits. Note that if the market value of the company increases, so will your dividend, which is why most investors put their money on larger corporations and less likely on small businesses. The two types of stocks. Here we're going to talk about the two main types of stocks, the common stock and the preferred stock. The first type of stock, which is the common stock, refers to stocks in general. A common share represents both ownership in a company and a claim on a portion of the profits. Common stock, by the way of capital growth, generates higher long-term returns than just about any other investment. Since common stocks are the most risky, higher returns come at a price. As soon as a company goes bankrupt and liquidates, the common shareholders will not receive any money until the creditors and preferred shareholders have been paid. Moreover, the second type of stock, the preferred stock, usually do not grant the same voting rights as common shares. Preferred stock usually pays a fixed dividend. It is different from common stocks, which pays variable dividends that are unguaranteed. Preferred stock, according to some, is more like debt than equity. To put this kind of share in perspective, they can be considered as a cross between bonds and common shares. Stocks versus bonds. What are bonds? Not to be confused with stocks. Bonds are another type of investment and they work differently from stocks. Unlike stocks, bonds are a debt security. An issuer of bonds seeks to raise money from investors willing to lend them money for a specific period of time. A bond is a loan you make to the issuer, which can be a government, municipality, or corporation. Though bonds and stocks do share similarities such as that both are able to make payments to an investor as well as change in value. However, the comparison between the two pretty much stops there. Perhaps the most important distinction between them is how they earn profits. Stocks must appreciate in value in order to sell later on the stock market, while bonds pay a fixed interest rate over time. Since the stock market is highly volatile, profits are less guaranteed. Equity investments are perceived as more risky for new investors, but their potential returns exceed those of bonds. Indeed, riskier investments have a better chance of rewarding investors, which is why most would prefer to invest in stocks rather than bonds. How the stock market works. The stock market, or the equity market, is kind of like an actual market, except instead of goods, people sell shares. In the stock market, buyers and sellers can negotiate prices and exchange or trade shares. Stock markets serve as vital components of a free market economy because they facilitate democratized access to trading and capital exchange for all sorts of investors. For beginners who want to get into the stock market, opening an online account is the easiest way to invest in stocks and mutual funds. But how does the stock market work exactly? Similarly to an auction house, the stock market is a place where buyers and sellers negotiate prices and trade. Public companies list their shares in the stock market and investors purchase those shares, allowing the company to generate money, which they then use to expand. In contrast to traditional marketplaces, where you'd have to be physically present to make bids, the stock market works electronically and online. Furthermore, there are many factors affecting the stock market's volatility. Tax and interest rate policies can influence the market, as well as regional and national economic factors. Best investment strategies to earning more in the market. Finally, let's talk about some good investment strategies you should take note of. Two most effective strategies in the stock market are the growth investing strategy and the buy and hold strategy. These two strategies have proven to increase your chances of earning more money when investing. Growth investing. This strategy focuses on increasing your capital as an investor. Investments in growth stocks usually involve young or small companies with earnings which are expected to grow at a faster pace than the sector or the market as a whole. Furthermore, growth stocks tend to do better when interest rates are low and are expected to remain low. The buy and hold strategy. The most effective strategy to earn more money in the stock market is the concept of buy and hold. This is also known as the passive and active strategy. Numerous investors swear by its success in the market. Basically, the buy and hold strategy is where you invest in the long term. Your investment should be held for at least 3 to 5 years, ideally before deciding to sell. There are several advantages to this strategy. One is that investing in this way is easier since you only need to pick investments right from the onset. Through this strategy, investors maintain a relatively steady portfolio over time, despite temporary swings. It is the preferred investment strategy of industry giants and has a proven track record of success. Hence, you might want to hold onto a stock for quite a while after purchasing it. All in all, keep an eye on the stock value. When its valuation no longer justifies the price, only then when selling may be the right thing to do. That's pretty much more of the basic things you need to know about how the stock market can provide you with large profits. Once you start investing, make sure to keep this information in mind so that you'll have better experiences and results in the future. Investing money can surely be risky, just like gambling, but knowing what to do will help you eliminate such risks and achieve the success you want. For beginners, the hardest thing to do is usually to take that step, as it can be very scary with your money being on the line. But don't worry, the higher the risk, the higher the reward. So take your chances while being cautious at the same time. Well, that's about it for today's video. For more information about stocks in the stock market, subscribe to the channel and hit that notification bell to get updated whenever we post new videos. If you found this video helpful, kindly click the like and leave a comment down below. We'd love to hear from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!